$10,000 put into Dividend stocks. What it pays you that first month tells you almost nothing about where this actually ends up, and that gap is the whole story. So is this even worth doing, or is passive income just a game for people already rich? Today, I'm building a real dividend portfolio, 10 stocks, $10,000 split evenly across all of them. I'll walk you through every stock I picked, how I pressure tested each dividend to make sure it actually holds up, and exactly what this thing pays you month after month. And by the end, I'll show you how this same $10,000 is projected to grow into over $200,000. Quick heads up, today's sponsor, Simply Wall Street, is the actual tool I used to build this and check every dividend, so I'll be showing you how it works as we go. Okay, so before you buy anything, you have to change how you look at investing. The normal way people do this is to buy a stock and then just watch the price. Up, down, up, down. It's stressful, and honestly, for what we're doing here, it's the wrong game. With dividend stocks, the question isn't how much the stock price goes up, it's how much the stock pays you for holding it. You're getting paid to own the thing. That's it. That's the whole idea. And there's one move that turns a small income into a big one. You reinvest every dividend. Every single dividend that lands automatically buys you more shares. Those new shares pay their own dividends, which buy even more shares. It starts tiny, a few bucks here and there, but that's the engine. Give it enough time, and it does the heavy lifting for you. But an income's only worth something if it actually keeps showing up every year, no cuts. So before a single stock went into this portfolio, I ran all 10 through one test. Here's the mistake almost everybody makes with dividend stocks. They find one paying some massive yield, 8%, 9%, and they think they've stumbled onto free money. But most of the time, that big fat yield is a warning label. It usually means the company's in trouble and that dividend is one rough quarter away from getting cut. So how do you tell a safe dividend from a trap? Well, you check. And this is where Simply Wall Street actually earned its spot in this video. Let me show you two stocks, because between them, they tell the whole story. First one, Verizon. It pays around 6.5%. 6.5% is a big yield. Now, by the rule I just gave you, your gut should be screaming, well, that's a trap. 6.5% is a big yield. So let's not guess, let's actually check it. Simply Wall Street runs 6 different safety checks on a dividend. Is it a strong yield? Is it stable? Is it growing? Is it covered by the company's earnings? Is it covered by their actual cash? Verizon passes all 6. 6 out of 6. Green straight down the line. The yield is real. The company earns way more than enough to pay it, and it's been paid and raised for years. So, that 6.5% everyone's too scared to touch, turns out it's one of the safest payments in the entire portfolio. That right there is the difference between checking and just guessing. Second stock, Exxon. And this one's the opposite problem. Okay, here's Exxon. And Exxon's more interesting because it's not all green. Pull it up, and you can see how Simply Wall Street points something out right away. The dividend isn't fully covered by the company's free cash flow. And on its own, that sounds like a problem. But this is the part people skip. That flag is a starting point, not a verdict. Investigating further, if you look right there on the same page, Simply Wall Street also shows you the other side of it. The dividend is comfortably covered by earnings, 68 cents on the dollar. And the track record? Exxon has raised this dividend 43 years straight. 43. Through oil crashes, through 2020, through every mess the energy market has ever thrown at it. A company doesn't pull that off by accident. So that cash flow flag isn't a dividend about to break, it's a company spending heavy money drilling for the next decade. 2 completely different things. And the balance sheet backs it up. So look at what just happened. One stock had a scary number that was completely safe, and the other had a scary warning that didn't mean what it looked like. None of this is complicated, and thanks to Simply Wall Street, you can read the whole picture instead of just half of it. And I did that with all 10 Dividend stocks for our portfolio. Here's the lineup that made the cut. First, I built it in 3 layers. Layer 1 is the boring, bulletproof stuff, the companies that pay you whether the economy's booming or falling apart. Procter & Gamble, the company behind half the things in your bathroom, has raised its dividend 70 years straight. PepsiCo, 54 years, then 2 utilities, NextEra and Black Hills. And Black Hills is wild, honestly. It's raised its dividend 56 years in a row and almost nobody has ever heard of it. These 4 are the anchors. Layer 2 is the blue chip muscle. Exxon, who you already met, Lowe's, which rides basically every home renovation in America, Lockheed Martin. And I love this one for a dividend portfolio because Lockheed Martin pretty much gets paid by the US government in any economy, war, or peace. Plus Johnson & Johnson, 63 years of raises, about as steady as a company gets. Then there's layer 3, the growth kickers. Goldman Sachs pays a smaller yield, but it's been hiking that dividend 18% a year. That's enormous. There's also Verizon, our 6% payer, doing the heavy lifting on income as well. Put it all together and you've got 10 companies across 8 different industries, every single one of them paying you to hold it. Okay, so here we go. 10 stocks, $1,000 each. Let's actually build the portfolio and see what it pays. Building it takes about 2 minutes in Simply Wall Street. And you've got a couple of ways in. You can link your broker and pull all your trades over automatically, or just upload them yourself. For this video, I opened the Portfolio tab, hit New Portfolio, and added each stock manually as a buy. Procter & Gamble, PepsiCo, and the rest. Check this out. All right, so I've already gone ahead and built the full thing out, all 10, $1,000 into each. And the second it's done, it tells you exactly where this portfolio stands, as well as what it pays you now and in the coming months. And here's the whole thing live. Now you'll see the values moved a little since I built it. Up a bit today, up a bit on the week. That's a plus. But the day-to-day wiggles aren't the point of a portfolio like this one. This is the point. Down in the corner, estimated dividends, $322 a year. That's this $10,000 portfolio paying you about $26, $27 a month just for holding it. And it's already got it marked as a solid income portfolio. We'll get into exactly how solid in a minute. But let's be honest about that number first. $27 on $10,000? That's a phone bill. If you came to this video for a get-rich-quick number, obviously that ain't it. And I'm not going to sit here and pretend it is. But $27 a month is the seed, not the tree. And what it grows into is the whole reason you're here. By the end, I'll show you what that $27 a month reinvested turns into, a $200,000 portfolio. It's a number a lot of people won't believe off a $10,000 start, so stick around, that's still coming. But first, is this a real portfolio or just 10 stocks I threw in a pile and called a plan? Simply Wall Street answers that in about 5 seconds. This is the part I actually love. Go to the Analysis tab, and Simply Wall Street takes all 10 stocks and grades the whole portfolio as one thing. Start over in the Dividends tab, and it scores the quality of every dividend you own, showing you where your income actually comes from. About 2/3 of your income comes from the highest quality, safest payers it tracks, and the riskiest bucket? 0%. That's what happens when you run every stock through these safety checks first. The junk never makes it in. Now, back over to the Analysis tab. It stacks your dividend up against the whole U.S. market. Your portfolio yields 3.2%, and the market average is 4.2. And normally you'd think, well, okay, I'm behind here. But think about what's dragging that market number up. It's all the junk. The 9-10% yield traps the company's about to cut. That average is fat because it's stuffed with dividends that aren't safe. Ours is a little lower on purpose. We threw out all the fat, and here's what you get for it. These companies are raising their payouts almost 8% a year and only paying about 62% of their earnings to do it. So there's plenty of room to keep raising. This income isn't stretched, it's got slack. Same tab, the valuation. The portfolio's sitting at 10 grand, but on a cash flow basis, most of these companies are undervalued right now. Simply Wall Street values what you own closer to $15,500, meaning the whole portfolio is almost 35% undervalued. So you're buying roughly $1 of value for 65 cents, a 35% discount. That's nice. And last one, right below that, diversification. 10 stocks across 8 sectors, none of them running the show. Staples, utilities, energy, healthcare, defense, telecom, all balanced out around 10% each. So if one corner of the economy takes a hit, the whole thing doesn't go down with it. And everything I just did there, the quality score, the valuation, the whole breakdown, you can run all of it with your own stocks, your own portfolio. And honestly, it's barely scratching the surface of everything Simply Wall Street does. So here's what I'll do. I'm dropping the link to this exact portfolio down in the description. You can open it up and see everything we just went through, live, moving in real time. And if you sign up using that same link, you'll get 30% off plus an extended 14-day trial, no credit card required. So go ahead, pull it up, poke around, and get the discounted price for your own portfolio. Now, let's look at what this portfolio is projected to pay month by month. Most of these companies pay quarterly, every 3 months, not every month, but they pay in different months, so it comes in waves. And Simply Wall Street lays the whole thing out on a calendar for you. Watch this. Here's August. Kind of a quiet month. Verizon pays you $16, Lowe's and P&G a few more. So the estimated dividend for this portfolio in August is around $30. September, everything hits. Black Hills, J&J, Exxon, NextEra, Lockheed, Goldman, Pepsi. 7 different companies pay you in the same month. All of that is estimated to be about $52. So no, it's not the same every month. Some months trickle, some months flood. And you can see all of it coming, the exact days, the exact amounts, mapped out months ahead. You're never guessing. And here's the part that matters most. This income doesn't sit still, it climbs. The companies just keep raising on their own. Which brings us to the real question. Leave this thing completely alone for 30 years. Where does it end up? Well, here's what the projections show. After year 1, it would sit at around $11,000. By year 10, it would grow to about $26,500. By year 20, it would reach roughly $72,500. The snowball starts to roll around here. The dividends reinvested around this time are buying serious amounts of new stock every single year. And by year 30, this $10,000 portfolio is projected to be worth over $200,000. And the income? Remember that $27 a month we started with? By year 30, this portfolio would be paying you around $636 every month. That's more than $7,500 a year just landing in your account from 10 grand. That's what time does. Now, $1,000 a stock feels like a lot to some people. So what happens if you start with just $25 a week instead? That one turns into a $700,000 portfolio paying over $5,000 a month. That video is on your screen right now.